there, and welcome. You've probably heard terms like GDP and national income thrown around constantly, right? On the news, online, they're everywhere. We use them to talk about how the country's doing. But what do those massive numbers actually mean? Well, today we're going to pull back the curtain and demystify the figures that, believe it or not, kind of shape our world.
So let's just dive right in. We hear it all the time. GDP is up, GDP is down. But what is it really a measure of? Is it a country's wealth? Is it our collective happiness? Is it progress? Well, it all starts with a very, very specific definition. Okay, here it is. Gross domestic product. The official definition is the total market value of all final goods and services produced within a country's borders during a specific period. Now, a lot of that makes sense, but there are two phrases in there that are absolutely crucial: final and within a country's borders. Let's break down why they are so important.
This first key idea, final, is all about avoiding something called double counting. To get a true number, you can't count the same value more than once. So imagine a farmer grows wheat worth, say, 50 rupees and sells it to a baker. Then the baker uses that wheat to bake bread that sells for 200 rupees. Now, if we just added those together, we'd get 250 rupees. But wait, the value of the wheat is already baked into the price of the bread, right? So GDP cleverly avoids this by only counting the value of the final product, in this case, the 200 rupee bread.
Okay, but that brings up another really interesting problem. If GDP is based on market value, what happens if the price of everything in the country suddenly doubles? It would look like our GDP shot through the roof, but did we actually make more stuff? Not necessarily. And yeah, economists have a pretty smart way of dealing with this. They give us two different flavors of GDP. First, there's nominal GDP, which uses current everyday prices. But this can be super misleading because it can go up just because of inflation. The one that really tells the story is real GDP. This one is adjusted for inflation because it uses prices from a fixed point in the past, a base year. This gives us a much clearer picture of whether our actual output has grown. And just to make this real for you, the current base year for calculating India's real GDP is the financial year 2011-12. So whenever you hear analysts talking about real economic growth, they're measuring it against the prices from way back then.
So we get the concept, right? But how on earth do you even begin to measure the value of every single thing produced in a country as massive and complex as India? It seems like an impossible task. Well, it turns out there are three main ways to get to that one magic number.
And you can think of these as three different sides of the same coin. You can measure the economy by looking at what everyone spends, that's the expenditure method, or you can look at what everyone earns as income, the income method, or you can add up the value of everything that's produced, the product method. And here's the beautiful part. In theory, they should all give you the exact same number. Why? Because every single rupee that's spent is a rupee of income for whoever sold the good or service. It's a closed loop.
Now, this equation is probably the one you've seen before. The expenditure method is by far the most common way we talk about GDP. And it's actually pretty simple. It's just the sum of all the spending in an economy, broken down into four neat little categories. Let's run through them real quick. C is for consumer spending. That's you and me, buying groceries, cars, movie tickets. It's the biggest piece of the puzzle. I is business investment, companies buying new equipment or building factories. G is government spending on things like infrastructure and defense. And finally, X minus M is net exports. Basically, our total exports minus our total imports. Simple as that. Okay, so this brings up a really good question. Remember how we said GDP is about what happens within a country's borders? Well, what about an Indian citizen who's working in, say, Dubai and sending money home? Or what about a foreign company that has a factory here in India? Where does all that money get counted? To answer that, we need to introduce GDP's slightly different cousin, Gross National Product, or GNP, and the difference is all in that one word, national. While GDP is all about geography, what's made here, GNP is all about citizenship. It measures the value produced by a country's nationals, no matter where on the planet they happen to be. Let's make this crystal clear. The money earned by a foreign company operating in India, that's part of India's GDP, but not its GNP. Now flip it. The money earned by an Indian citizen working abroad, that's part of India's GNP, but not its GDP. See? It's just a simple switch in what you're focusing on, the location or the passport.
All right, you ready to go one level deeper? So far, we've been talking about gross numbers, GDP and GNP. They're the big top-level figures. But to really understand what a country truly earns, or its national income, we need to peel back a couple more layers.
So, we'll start with that big GNP number. But think about it. Over the course of a year, our country's assets, our factories, our machines, our roads, they all get a little bit older, a little bit worn out. This wear and tear is a very real cost of producing everything. And to get a true picture of our income, we have to subtract it.
And there's an official name for this, of course. It's called depreciation. You can think of it as the cost of using up our country's capital goods to make all that stuff. It might just be an accounting entry, but it represents a very real cost of production.
So once you take your gross national product and subtract the value of that depreciation, you get something new, net national product, or NNP. And just like that, we've gone from gross to net. This new number is more refined. It's net of the capital that got used up in the process. We're getting much closer to the real income figure.
But we're not quite there. The price you actually pay for something in a shop, the market price, isn't usually what the person who made it gets to keep, right? The government often adds on indirect taxes, like GST, which raises the price. And sometimes it gives subsidies, which lowers the price. We need to account for this gap.
And after we make that final adjustment, basically stripping out the distorting effects of those taxes and subsidies, we finally arrive at net national product at factor cost. Now, factor cost is just a fancy way of saying this is the actual income that was earned by the factors of production, the workers and the owners of the businesses. And this number, right here, this is what economists truly call national income.
Whew. Okay, we've been deep in the weeds with all these calculations, but it's so important to take a step back and think about what it all means. Even centuries ago, Adam Smith pointed out that a country's well-being isn't just about what it has, it's about how it uses what it has to create value.
Which brings us to the biggest, most important question of all. We're always told that a rising GDP is good news, that it's a sign of success. But does a bigger number in an economic report automatically translate to a better life for everyone in the country?
Well, the short answer is a hard no. And here's why. First, GDP is just a total. It tells us nothing about how that income is distributed. A country could have a huge GDP, but with all the wealth concentrated in the hands of a few. Second, it completely ignores any work that isn't paid for. Think about all the incredibly valuable work done by caregivers at home. It contributes zero to the official GDP. And finally, GDP can actually count negative things as positives. A factory could pollute a river, causing huge health problems. But GDP only registers the value of what the factory produced, not the massive cost of the pollution.
So here's the bottom line. GDP is a fantastic, powerful tool for measuring economic activity. It's incredibly useful for what it does. But it was never, ever designed to be a complete report card on a nation's well-being. It's one number in a much, much bigger story about who we are and where we're going. And that really leaves us with a final, massive question to think about. If GDP isn't the whole story, what else should we be looking at? What other numbers? What other metrics do we need to truly understand if a society is making real progress? Now that is something worth thinking about. Thanks so much for joining me.